Picture this. You wake up, check your phone, and see that silver just hit $90 per ounce, an all-time high. You think it's a typo. You refresh. Nope. The metal that's been called poor man's gold for centuries just shattered every record in history. And it's not slowing down. But here's the question that's keeping investors up at night. Is this the beginning of a massive bull run that could take silver to 150, 200, maybe even higher? Or are you staring at the biggest bull trap in commodity history, about to crash harder than it rose? Right now, in January 2026, silver is doing something it's never done before, and the reason isn't just demand. It's not just inflation. It's something far more strategic and far more dangerous. China just pulled the trigger on an export ban. Industrial demand is exploding, and the supply squeeze is getting tighter every single day. Before we dive into whether you should buy, sell, or run for the hills, smash that subscribe button and join the Wealth Forum. We break down the economics and investment strategies you need to navigate markets like these. Today, we're answering the $90 question. Should you buy silver right now? Let's find out. To understand what's happening with silver in 2026, you need to understand that silver isn't just a precious metal. It's a dual identity asset, half investment, half industrial commodity. Gold is easy. It's a store of value, a hedge against inflation. Central banks hoard it. Investors love it. But gold doesn't do much. It sits in vaults looking pretty. Silver is different. Yes, it's a monetary metal with thousands of years of history as currency. But it's also the most conductive metal on Earth. It's essential for solar panels, electronics, batteries, medical devices, water purification, and countless industrial applications. About 60% of silver demand comes from industrial uses. That makes silver uniquely vulnerable and uniquely valuable at the same time. Here's the historical context you need. For most of modern history, silver traded in a ratio to gold. The gold to silver ratio has averaged around 60 to 1 over the long term, meaning if gold is $1,800, silver should theoretically be around $30. But silver has always been more volatile. During the 1980 Hunt Brothers manipulation, silver briefly hit $50 per ounce. In 2011, during the aftermath of the financial crisis, it hit $49, and then it crashed. Hard. For nearly a decade, silver languished between $14 and $20. Investors gave up on it. It became the forgotten metal. But something changed in 2020. The pandemic triggered a perfect storm for silver. Governments printed trillions. Inflation fears exploded, and suddenly, green energy became a global priority. Solar panels require silver, lots of it. Each solar panel uses about 20 grams of silver, and the world is installing solar panels at an unprecedented rate. By 2024, silver was back above $30. People started paying attention again. But even the bulls didn't expect what happened next. In late 2025, whispers started circulating that China was considering restricting silver exports. Not just silver, but also gallium, germanium, and other critical minerals. Strategic resource nationalism. By January 2026, those whispers became reality. China implemented export controls, and silver went vertical, from $35 in December to $90 by mid-January. That's not a rally. That's a moonshot. And it's left everyone asking the same question. What the hell just happened? And more importantly, what happens next? Let's break down the mechanics of what's driving silver to all-time highs right now. There are three main forces at work: supply constraints, industrial demand explosion, and investment mania. We need to understand each one. First, supply constraints. Silver isn't like gold. Most silver isn't mined primarily for silver. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. That means when those base metal mines slow down, silver supply slows down too. Global mine production has been relatively flat for years. We're producing around 850 to 900 million ounces annually. But demand is growing faster than supply. The deficit between what we mine and what we consume has been widening. Now add China's export ban into the equation. China is one of the world's largest silver producers, mining around 3,500 metric tons per year. That's roughly 112 million ounces if China stops exporting that silver and keeps it domestically for its own industrial use. The global market just lost over 10% of supply overnight. But it's worse than that. China isn't just restricting silver. They're restricting the entire supply chain, refining capacity, processing, export logistics. Even if silver gets mined elsewhere, if it needs to be refined in China, it's stuck. This is economic warfare disguised as industrial policy, and silver is caught in the crossfire. Second force, industrial demand explosion. Let's talk about solar energy. The International Energy Agency projects that solar capacity will triple by 2030. Every megawatt of solar requires silver. Current estimates suggest that solar panel production alone will consume around 130 million ounces of silver annually by 2030. That's 15% of total global supply just for solar. Then you have electric vehicles. Silver is used in EV battery connections, circuits, and charging infrastructure. As EV adoption accelerates, so does silver demand. Add in 5G technology. Every 5G base station uses significantly more silver than 4G. Medical applications, electronics. The industrial demand side is a runaway freight train, and there's no substitute for silver in many of these applications. You can't just swap it out for copper or aluminum without losing performance. Third force, investment mania. When silver starts moving, retail investors pile in. It's cheaper than gold, more accessible. You can buy physical silver coins, bars, ETFs, futures, mining stocks. Silver has always attracted a passionate retail following. Communities like Wall Street Bets and Precious Metals forums have been pushing silver for years. In 2021, there was a silver squeeze attempt that drove prices briefly higher. Now, with silver actually hitting all-time highs, those communities are going insane. FOMO is real. Social media is flooded with silver content. YouTube thumbnails scream about silver going to $200. TikTok videos show people buying silver by the trunkload. When retail gets involved in a commodity with limited liquidity, things can get explosive. But here's where it gets tricky. Silver markets are relatively small compared to other assets. The entire above-ground silver supply is estimated at around 2 billion ounces. At $90 per ounce, that's about $180 billion. That's smaller than many individual companies' market caps. It doesn't take much capital to move silver violently in either direction. Hedge funds know this. When price momentum builds, algorithmic traders pile in. Momentum begets momentum, but the reverse is also true. When sentiment shifts, silver can crash just as violently as it rallied. Now let's talk about the China angle specifically. Why would China ban silver exports? Strategic resource control. China is the world's manufacturing hub. It needs silver for its own industrial base. Solar dominance, EV production, electronics. By keeping silver domestic, China ensures its industries have supply while the rest of the world scrambles. It also puts pressure on Western economies that depend on Chinese supply chains. If you're a solar panel manufacturer in the US or Europe and you can't get silver, your production stops. That gives China leverage, economic coercion through commodity control. We've seen this playbook with rare earth elements. China controls over 80% of rare earth processing. They've used export restrictions as political leverage before. Silver is the next frontier, and it's working. Prices are spiking. Western industries are panicking, and China is sitting on stockpiles. So we've reached the critical moment. Silver is at $90, all-time high. Supply is constrained. Demand is surging. China is weaponizing exports. The momentum is undeniable. But here's where you have to shift from cheerleader to skeptic. Because markets don't move in straight lines, and silver has a brutal history of crushing late buyers. Let's examine the warning signs. The red flags that suggest this rally might be running on fumes. Warning sign 1, parabolic moves always correct. When any asset goes vertical in a short period, physics applies. What goes up fast comes down fast. Silver went from $35 to $90 in roughly 6 weeks. That's a 150% gain in a month and a half. Historically, parabolic moves like this are followed by violent corrections of 30 to 50%. Even if the long-term trend is bullish, short-term pullbacks are inevitable. If you buy at $90 and silver corrects 40%, you're looking at $54. That's pain, real pain, especially if you're leveraged or bought on margin. Warning sign 2, sentiment is euphoric. Contrarian investors know that when everyone is bullish, the top is near. Right now, silver sentiment is off the charts. Social media is 100% bulls. No one is talking about downside risk. Everyone assumes it's going to 150 or 200. When taxi drivers start giving you silver tips, it's time to worry. Euphoria is the enemy of rational investing. Markets punish consensus. And right now, the consensus is screaming buy silver. That's historically a terrible time to enter. Warning sign 3, industrial users are getting crushed. Here's the dark side of silver's rally. While investors are celebrating, industrial companies are suffering. Solar manufacturers are seeing their input costs explode. Margins are getting destroyed. Some companies are halting production because they can't afford silver at $90 per ounce. If industrial demand starts to crater because price kills demand, you've removed one of the 3 pillars holding silver up. Demand destruction is real. It happened to oil in 2008. It happened to lumber in 2021. It can happen to silver now. Warning sign 4. Substitution becomes viable. At $90, companies will desperately search for alternatives. Can we use less silver per panel? Can we replace it with copper in some applications? Can we redesign circuits to minimize silver content? When prices go parabolic, innovation accelerates. R&D budgets get approved overnight. If substitutes emerge or efficiency improvements reduce silver intensity, long-term demand projections crater, and so does the bull case. Warning sign 5. China could reverse the ban. Geopolitics is fluid. If China faces domestic backlash or economic pain from the export ban, they could reverse it. Maybe partially, maybe temporarily. But even a hint that Chinese silver might come back online would crash prices instantly. Markets front-run news. The moment there's a rumor of policy shift, silver could gap down $10 or $20 in a day. You'd have no time to exit. Warning sign 6. The dollar could strengthen. Silver is priced in dollars. When the dollar strengthens, commodities typically fall. If the Federal Reserve holds rates higher for longer, or if global economic uncertainty drives safe haven flows into the dollar, silver gets hit. You're not just betting on silver fundamentals. You're betting against dollar strength. That's a second variable you can't control. Warning sign 7. Physical versus paper divergence. Most silver trading happens in paper markets. Futures, ETFs, derivatives. Only a fraction involves physical delivery. If there's a disconnect where paper prices crash but physical stays elevated due to shortage, you could be holding an ETF that plummets while physical silver owners are fine. Conversely, if physical premiums collapse and paper leads lower, everyone loses. The point is market structure matters. And silver's market structure is fragile. But let's Steelman the bull case too, because ignoring it would be dishonest. The bulls argue that $90 is just the beginning. Here's their logic. Silver is still undervalued relative to gold. The gold to silver ratio is currently around 28:1. Historically, during precious metal bull markets, that ratio compresses to 15 or even 10:1. If gold is at $2,500 and the ratio goes to 15, silver should be at $167. That's nearly double from here. Structural deficits are real. We're consuming more silver than we're mining. That deficit has to be made up by above-ground stocks. Eventually, those stocks run out. When that happens, price has to rise enough to either incentivize more mining or kill demand. We might not be at that equilibrium yet. Green energy transition is unstoppable. Governments have committed trillions to decarbonization. Solar is central to that. Even if some substitution happens, the sheer scale of solar deployment means silver demand will remain massive. China's export ban might be permanent. If this is part of a broader deglobalization and resource nationalism trend, China has no incentive to reverse it. They benefit from keeping silver domestic. The rest of the world suffers. That asymmetry supports higher prices. Investment demand is just starting. If silver breaks $100, institutional money that's been sitting on the sidelines might finally enter. Pension funds, sovereign wealth funds. At that point, the rally could have another leg. So who's right? The bears warning of a crash or the bulls calling for $200? The honest answer is nobody knows. Silver is trading on sentiment, technicals, and geopolitical chaos. Fundamentals matter, but they're being overwhelmed by momentum and fear. Let's talk about what happens next, depending on which scenario plays out. If silver continues rallying to $150 or $200, the consequences are enormous. For investors who bought early, life-changing wealth, people who accumulated silver at $20 or $30 are sitting on 4 to 7x gains. That's retirement money. Generational wealth for some. Mining companies explode. Silver miners' stocks are leveraged plays on the metal. If silver doubles, mining stocks can triple or quadruple. Companies like First Majestic, Hecla, Pan American Silver, their share prices go parabolic. Early equity investors get rich, but industrial chaos ensues. Solar manufacturers either pass costs to consumers, killing adoption, or eat the losses and go bankrupt. Electronics get more expensive. EVs get more expensive. The green transition slows because input costs are too high. Governments might have to subsidize industries just to keep supply chains functioning. Inflation accelerates. If silver is spiking, other commodities are probably moving too. Copper, lithium, rare earths. The entire commodity complex heats up. Central banks are forced to choose between fighting inflation with rate hikes or supporting growth. Emerging markets suffer. Countries that rely on importing silver for manufacturing face balance of payment crises, currency devaluations, economic instability. Now the alternative scenario. Silver crashes from $90 back to $50 or $60. Late buyers get destroyed. Anyone who FOMO'd in at all-time highs loses 30 to 40%. Retail investors who leverage positions get margin called and wiped out. This isn't theory. This is what happened in 2011. Silver hit $49, then crashed to 26 within weeks. People lost fortunes. Mining stocks collapse. The leverage works both ways. When silver falls, mining stocks fall harder. Shareholders get crushed. Analysts who are screaming buy at 90 are nowhere to be found at 60. Industrial users breathe a sigh of relief. Costs normalize. Production resumes. The green transition continues without input cost panic. But trust in commodities gets shattered. Retail investors who got burned swear off silver forever. It's manipulated. It's rigged. Never again. The silver community fractures. Bulls blame manipulation. Bears say I told you so. And the metal goes back to being ignored for another decade. The middle scenario, silver consolidates. Maybe it pulls back to 70 or 75, then trades sideways for months. Volatility remains high. No clear trend. This is actually the worst scenario for traders because you can't make money. You're just chopping around getting stopped out repeatedly. But it might be the most realistic. Markets rarely resolve cleanly. They grind. They confuse. They punish both bulls and bears. So what's the lesson here? What should you actually do with silver at $90? First, understand that you're not investing. You're speculating. At all-time highs, you're not buying value. You're buying momentum. And momentum is the most dangerous game in markets. It works until it doesn't. There's no margin of safety. You're relying on greater fools to buy from you at higher prices. That can work. But it's gambling, not investing. Second, position size matters. If you're going to buy silver at these levels, it should be a small speculative position. Not your life savings. Not money you need. Money you can afford to lose entirely, because that's a real possibility. Third, have an exit plan before you enter. What's your stop loss? At what price do you admit you're wrong? If you buy at 90 and it hits 85, are you out? Or are you holding hoping it bounces? Hope is not a strategy. Define your risk before you click buy. Fourth, physical versus paper matters. If you believe in a supply crisis, you want physical. Coins, bars, stored securely. Paper silver can be created infinitely. Physical cannot. But physical has premiums, storage costs, and liquidity issues. Know what you're buying. Fifth, zoom out. Silver has a long history. It's had multiple bull markets and brutal bear markets. The fact that it's at all-time highs today doesn't mean it's going higher tomorrow. Sometimes all-time highs are beginnings. Sometimes they're endings. Context is everything. Sixth, don't let FOMO override logic. The fear of missing out is the most expensive emotion in investing. Yes, watching silver run from 30 to 90 hurts if you didn't own it. But chasing it at the top and losing 40% hurts more. There will always be another opportunity. Always. Missing this one doesn't mean you failed. Finally, remember that markets are ruthless. They don't care about your hopes or your investment thesis. They care about supply and demand. Sentiment, liquidity, geopolitics. All of those variables are in flux right now. Silver could genuinely go to 150. Or it could be back at 60 in 3 months. Both are possible, and that uncertainty is exactly why this is so dangerous. You're not making an informed bet, you're making a leveraged guess in a chaotic system. Here's my final question for you. After everything we've covered, are you buying silver at $90? Or are you waiting for a pullback, knowing you might miss further upside? Are you someone who believes this is the start of a multi-year bull run to 200 plus? Or do you think this is a classic blow-off top that's about to punish late entrants? Drop your answer in the comments. Are you buying now, waiting for a crash, or avoiding silver entirely? If this breakdown helped you think more clearly about silver and the risks involved, smash that like button, subscribe to the Wealth Forum, and hit the notification bell, because we'll be tracking this story closely. Whether silver moons or crashes, we'll be here breaking down what it means for your money. Remember, in markets like these, protecting capital is more important than chasing gains. Stay disciplined. Stay rational, and never invest more than you can afford to lose. I'll see you in the next one.